My name's Richard Goers. My background is 45 years, would you believe, in the financial services markets. Basically, 20 years as an institutional proprietary trader across currencies, commodities, and fixed income and their derivatives, spot and derivatives. For about 5 years, I started a hedge fund and various other platforms for parties to communicate from foreign exchange and securities. And for the last 20 years, I've been in as head of risk for various OTC retail derivative exchanges, banks, superannuation funds, and advisory services in the currency. So it's essentially been 45 years in the financial markets, building out the risk management frameworks, compliance, all the way through to the trading side, running trading desks and starting from scratch, having to learn how to trade as a professional. So I can bring that sort of experience to any OTC exchange and funded trader program. Part of my experience has been applied to the market risk and liquidity risks of OTC exchanges, as well as the operational side, so building out the capital models, margin models, to trader profiling. So working through how we run A and B books in the CFD brokers. So that's been 20 years in development. I'm not sure there's been much serious advancement in the way brokers profile clients from where I've seen, to building out risk management software applicable to the platforms to hedge their exposures. And this now applies to funded trader programs. Yes, I've spent nearly 5 years, or have spent 5 years at ASIC, the regulator. My interest was piqued with the advent of the crypto. So I was brought in market infrastructure, which our mandate is to monitor the stock exchanges in Australia, monitor the unlisted platforms that's selling shares, and as well as the DeFi crypto exchanges. So it was a very interesting mixture. Obviously, the stock exchanges are very highly regulated. We have the MIR rules, so that's where I can bring in the policy work around the exchanges and how they operate. The unlisted share trading platforms just built very similar to CFD broker platforms, and obviously then in the DeFi space is where most of the product development has occurred and the most interesting stuff, and they're completely unregulated, or have been, or will be, or until the regulation gets in. Some of the products coming out of there are most interesting, especially their minimized leverage programs, how they can stop traders getting margin called. My view is that my interest is that the DeFi space having to move into the TradeFi space and digitalizing real world assets is going to be one of the largest movers, or the trend. The DeFi space has had horrible platforms, horrible user experience, and obviously rug pulls and fraud left, right, and center. But I think the wallet development and their platforms are moving into a user experience where the focus has been on user experience, whereas before it was on just the build out of the code and so forth. And I think they are going to become a dominant force in the retail trading space, especially how they can bring in the cryptos and then how they can bring in digitalizing everything else. So it's going to be interesting to see how they can even compete against the stock exchanges. Well, I've been around long enough to have seen the evolution evolve from what everyone describes as a Wild West, very light touch regulation back in the early 2000s, up until now, where the regulation hit them in about 2018 to 20, and how it's impacted the market. I see that evolution coming through both the DeFi space into the becoming more centralized, getting regulated, as well as the funded trader programs being unregulated, moving in. So the sheer number of funded trader programs, if I can focus on that, and how they're managed. So from my perspective, I think what I know I can do is, for the Funded Trader Association, is to be able to provide several levels or several modules. One is if we're thinking about the funded trader programs are going to be regulated, or that they will be regulated, being able to provide the policy documents, the processes and dashboards and so forth for these funded trader platforms to meet regulatory standards, which is robust business processes, business continuity, down to governance around conflicts of interest and so forth, that really suit how regulators have imposed upon the CFD brokers, and made them, the compliance program is quite not so much of a headache. It's essential. Biggest problems traders face naturally would be the fact that the payouts, that the fact that get paid out according to the terms and conditions. Secondly, that their platform they've chosen survives, doesn't fall over, so to speak, or just not operate. And thirdly, that the terms and conditions, or the complaints, how the platform deals with their complaints in a fair and honest manner. So it's a trust relationship. That's the main pain points from the trader's side. From the platform side is essentially, I think, two, if I can make it simple, two. One is that if they're going to be regulated, they have the compliance and risk management frameworks suited and customised to their business line, complexity and so forth. That's an interesting point. So we can build that out for them. And second is that the risk management framework in relation to exposure, they can make money, that they can survive and they can prosper, so all participants within their ecosystem do well, so to speak. Again, I'm trying to draw upon the CFD side. So you'll get manipulation, not so much manipulation. You find the spreads changing on you to your detriment. So it's the first sign is a late payment or no payment, or all of a sudden they close your account. It's all then too late for you. But if you're operating, if you're trading, I don't think they can change the terms and conditions. But there's it was an interesting, I guess the most interesting example was FTX, when it fell over, and the process by which it took maybe 3 or 4 days before it happened. That was a very social media environment, but it was very hard for, once it happened, it was devastating. But when you look back on it and you're trying to say, well, could I have done better due diligence on FTX? It's probably the best case study I would know of. So it was hyped in the media, but there were parts of the media that were telling you to be very careful. And then the article came out of the blue and about their token, and then it literally ended there and then. And it was very hard to get your money out on time, and it just ended in tears. So if you look back at that, I still have the due diligence would be, if you can, as a trader, you look at the experience, if you can get the information on the experience of management. If it's a CFD broker that's offering funded trader, fine. They generally offer them offshore, so there's less regulatory around it, but they would have pretty strong risk management frameworks to ensure their survivability, even though it's a slightly different game between funded trader and the traders on their book. I think that's the clearest one. So there would be that regulatory side, and then given that the funded trader program is less regulated, hopefully there's an overlap in the way they would manage their business. But it's, how long they've been in the game. So it's basic due diligence. Whereas if you had a straight funded trader with rented technology and a marketing team, you're probably more than likely find out from social media that there's some problems. So I would imagine you keep clear eye on whatever's out there. I think it's Reddit and Twitter and so forth. I would try and join one of those sort of social medias, and just keep an eye out on comments made about. I'm not sure about Trustpilot's into this space, but yeah, it's difficult. It's difficult. In hindsight, you probably could have gone, if something does happen and the broker just stops business, as well as you can follow prop association, and we'll keep you abreast of developments as we see them. But so it's through time there will be a shifting of the dominance. You'll get 300 funded trader programs all across a different perspective, running into the top tiers that you would understand, established traders with large accounts trading through that. That transition period, you'll need as much help as you can, and whether it's through the prop association or whether through social media, you should keep an ear to the ground there. I mean, the CFD industry has like Trustpilot and so forth. So there's certain media outlets which will be one of alerting you to, as well as, of course, the funded trader programs listed on the prop association. We do the due diligence on them ourselves, so you'll get a much better feel if you deal through them than the enticements that will be seen in the multitudes out there of the platforms. The benefits to the trader of funded trader program. Yeah. I mean, this is, I guess, why I'm here. I have this, I believe the funded trader program and the products it offers, or the opportunities it offers, and it's been around for a while. So I think I was even trying in late 2018-19 through some UK. If you're a retail trader, or you are a retail trader, so to be able to have an opportunity to get even notional capital and trade on that and start developing your skills, learning through doing as opposed to reading, and all the support services you can get across the media, so YouTube and so forth, and the lessons and so forth, education. I think it's a real opportunity for some people to, when they hone their skills, without a background in quant maths and so forth, where you would go for the high frequency trading firms, would be to be able to create an income, whether it's passive or even full-time income through time, is amazing. It's the platforms have evolved, the industry's evolved. You can now almost get 24/5 trading in US stocks or global stocks, and as via derivatives. It's such an amazing time. And as the platforms evolve, and the ones who want to actually work for their traders, you're going to get so many opportunities for the average trader to evolve into something and learn a skill set that sets them up for life. Okay, so my thoughts are that the industry will evolve. You've got the ASIC trader, where the trader brings his own skill set, his own rules, and as long as he makes money, that's fine. Then you've got the others that are very strict on their rules. Break a little bit and you're out, kind of thing. If you move beyond ASIC, you can go to the quant trading firms who would train traders with their rules to use their capital. So it's all kind of very controlled, to going to a prop house where you bring your own skills and they'll just let you trade. So there's degrees of freedom out there. If you're just a starting up trader, you probably will make lots of errors and take a long time to learn, and then you'll probably kick in. So the education programs that are available from the prop association should help. If you take it as a profession and a learning cycle, it took, generally in my times, the apprenticeship was about 5 years before you became a full-fledged trader. That's with very strict controls around capital. The journey of the beginner trader in this program, in this kind of landscape, funded trader, should be one of should be looking to learn through time. You're going to be making a lot of mistakes, but if you're looking to make this as probably a secondary passive income, or a future income for you as a full-time trader, you're going to take 3 to 4 years or 5 years. You shouldn't look at this as a get-rich scheme very quick, because you'll essentially end up zeroed out. There's a lot of things you should consider. So the amount of leverage that these platforms allow you to take, the number of products, So you can see there'll be a big difference between the top-tiered firms and let's say the multitude of the bottom-tier firms in terms of the rules by which you trade. If they're too strict, you can get knocked out a lot. If they allow you too much leverage, you're certainly going to be you're going to end in tears. So I think when you start to compare, you will be able to see the firms that will be on the prop association having a fair set of rules, and they look like that you can use them over the long term, learn how to trade through those rules and adopt your own, and you can see the degree of flexibility or the ability to be unbounded by a set of rules for you to make money, whereas the firms that are probably looking to have you stopped out, so to speak, would have much stricter rules, very, very fine touch and you're out, and large leverage, very high leverage, enticing you to take greater punts. So it's not so much like, is it too good to be true? It's more like you need to be disciplined in thinking that a lot of the options you're going to get, not always the best choices you can take. So you might want to look at some top-tiered firms that would be on our platform, on the association, and see how they would be differing to smaller firms, and try and adopt a style with discipline around your trading for the long term.